Look, I gotta go now.
Oh, wait a minute. I don't know if yeah, I sent Kelly. I sent everybody, all 12 of them, yeah. Oh, Doris is in Milwaukee.
Yeah, I knew she wasn't gonna be here. Okay, we are live.
All right. Good evening, everyone. A good almost evening, everyone. Welcome to our investment committee meeting today, June 18th. And we're gonna get started with a roll call vote.
Christina Bennett. Candace Carter Oliver. Louis Cross.
Present.
Kelly Dobell. Mary Donaldson. William Heisey.
Present.
Emily Hubbard. Shanice Johnson. Yvette Levy. Jennifer Orr. Albert Sanders.
Present.
Andrew Vian.
Present.
Doris Walker. And Candace Carter Oliver.
Present.
All right, so we do have 5, so we do have a quorum.
All righty. Welcome, everybody. And I think we're gonna go into our hands on our investment advisors. Jeff. On you. All right.
You didn't say anything about Guelda.
I was almost gonna have to
about the
apologize
story of the show? Come on, man.
for
I was
Gwelda because she
Come on.
was
I know you see her down there.
I was gonna, my things aren't only at the top, and Gwelda's
you
here,
see
but Jeff, hurry up and push this unmute button. So I was like,
okay, well,
I guess
see.
Jeff is presenting first.
Oh, man. Come on. This
you
is
have to be
Florida-
quick. It's like a
this
game
is
show with
Florida
the
State's
mute button.
finest. This is Florida State's finest. Come on now. They almost won the championship. They lost, but they almost won. Is that right, Guelda?
Yeah.
Let me go. We're gonna start our investment committee, and we're gonna turn it over into our hands of our investment advisor. See, I threw it off. Gwelda and Jeff.
Praise the Lord.
There you go. Gwelda, have at it.
Bingo.
Okay, so our first thing I think you all wanted to start with the manager. We have DFA here and they manage a microcap portfolio for you on the domestic equity side, and they also manage an emerging markets portfolio. I don't know if they're in the waiting room,
Yeah,
but unless there's some questions that the committee has before they come on, you can go ahead and let them in, Sue.
okay, no questions. Yeah, there's 2 of them.
Sue, do you have their presentations?
I do.
Okay.
Good afternoon.
Good afternoon.
Good afternoon, Kevin. How are you?
Afternoon.
I'm great. How are you? Okay, there's the video.
There we go.
And my cohort.
Yeah, Gavin is there.
Okay, okay. It keeps opening up. There we go. Wonderful. Okay.
So, do you want to start with the educational piece of that presentation? I'll bring that up, and then you can just direct me when you want me to move forward.
That sounds great.
Okay, and is that the one that's it says market timing is like the
Correct.
first?
Yeah.
I can share it as well if that's easier. So whatever works better for you all.
You got it.
And I'll just recap really quick for the committee that we've asked Dimensional to spend an hour and 30 minutes of that just on straight education that you all can apply towards your continuing education credits. So they'll do that, and then we ask them for another 30 minutes on just an update on the two portfolios that they manage for the system.
Great, sounds good. Well, I can dive in if that works for everybody on the call. Great. Cool. All right, I'll start on slide 2. So we're going to cover a few different topics that we thought might be of interest to the panel here. So market timing will be the first one, then concentration risk, international diversification, and just kind of more of a primer on emerging markets and discussing what, kind of what is an emerging market, how have those evolved over the past 20 years or so. But first off, we'll dive into market timing on the next slide. And so for a little bit of background just about our firm, we do not try to market time. We think it's extremely difficult to do so with any amount of precision. So that's definitely not a tactic that we use. I like to kind of use the quote from Yogi Berra and others of it's tough to make predictions, especially about the future, right? So that's kind of the stance that we take more or less. And we can take a look at the next slide here. Yeah, this one, sorry.
Hey, Gavin, really quick too. Can you just
Yes.
give us a quick bullet point on what you're talking about when you talk about market timing?
Yes, sorry. So in terms of market timing, it's essentially trying to tactically allocate to either fixed income or equities, or even within the equity space, tactically allocate between, say, premiums like value and growth, or profitability and low profitability, or small caps and large caps. So really in that entire vein of timing, whether it be the market generally, fixed versus equities, or the premiums, that's again, very difficult and not something that we practice here at Dimensional.
Okay, so along those lines, so we've had a really good run in the equity markets, and the group here can see that on the returns. So would this be a good time for us to say, let's get all of our money out of the equity markets and just put it into cash?
Right, to that point. And we don't have it in this presentation, but we do have other materials that talk about, investing at all-time highs, those sorts of things. And from what we find in that, it's not here, but I'm sure we could share it with you. Investing at all-time highs versus any other time in the market, going forward, those returns are really not much different. And if anything, they're a little bit higher than historical returns. So I think from that perspective, to your point on moving from equities to all cash, we don't see any evidence of that being a beneficial strategy. On kind of the topic of how well can people forecast, this is a slide that I think is helpful to really just illustrate that point. So these are 19 of the largest banks in the world that all have economists and forecasters, and this is looking at 2025 from the best forecast at the top of 21% for the S&P to the worst at 2% at the bottom, the median being 12.2, which is roughly in line with what the S&P has returned over its life. And then we have the actual S&P return of about 16% in 2025. So this was actually a year where at least the analysts were able to cap and really put bands around what the return was going to be. Historically, if we look back the past 5 years on the next slide, what we found is that those green dots on the top and bottom, which represent, there we go, perfect. The green dots on the top and the bottom represent the actual return, and then the light teal square and the red square represent basically the range of estimates from these, top forecasters. So prior to last year, over the past 5, they weren't able to really even get the band of where the return would be. And so these two slides are really going to the point of, even for very talented professional investors, it's difficult to even predict the aggregate return of the market, let alone any individual security. And so this is really just some of the evidence behind why we're not trying to do that type of an activity of timing the broader markets or timing the premiums as well. If we go into the next slide, This is just trying to illustrate how rare it is for the market to even return its average. So these are the market returns, S&P 500, over the past roughly, call it 100 years. Teal on the top is obviously positive, red below that is negative. And then that light gray bar going horizontally above the 0 point of the x-axis, that's a band of 2% around that average return for the S&P over this period. And we only find that 7 times out of the past 100 years has the actual return even been within that average. So just one more point to drive home, just because that's the average, even if you were to guess that that was going to be the return of the market that year, you would more than likely be wrong. Next up, we talk a lot about, and you brought it up at the beginning of the call, of should we get into equity, or sorry, out of equities into cash, for instance, and kind of time that market. So this, I think, is an interesting, quick little study of what would happen if and I think oftentimes we want to go to cash and to your point, in this case, it'd be because the markets are doing well, but oftentimes I'd argue that it's a lot of times the markets are doing really poorly and you capitulate and you feel as if I just need to take a risk off the table. And so what we've looked at is if you missed the best 1 week, 1 month, 3 months, or 6 months over the past 25 years, what would that look like in terms of your actual return? So if you were, fully invested a growth of $1 back in 2001 and just stayed the course, you would have about $8,360. If you pulled your money out of the market for just 1 week, the week ending November 28th, 2008, so pretty close to the depths of the GFC, you would only have about $7,000, right? So decreasing by that $1,300. For the 1 month period, that would have been during COVID. You'd be down a little bit more. If you had taken that cash out for 3 months, you'd be down even more, down to $5,800. That again was during COVID. And then finally, if you'd stayed out for the 6 months, essentially following the March 9th low of the GFC, you would only have $5,425. So trying to illustrate, again, trying to time those markets, especially in this case, at points of distress, is likely not going to end up as a good result for your overall growth of wealth. But I think you could probably somewhat similarly look at this at the other case, and we have some data to that too, of if markets were doing really well and you decided to take your money out, right? You'd likely see at least, maybe not exactly the same, but similar as far as that decline in the growth of wealth. So to close up this section, this is something we like to just kind of highlight as well. I think it's at any given time, it's easy to highlight what's going wrong with the markets and what could be a negative impact to markets. I think, recent history, the past 3 months is a good example of that, where oil had been going up pretty significantly, but we had a very strong Q2 across the board, whether it's the US or outside the US, despite high oil prices, concerns of inflation, and everything like that. So this is really just highlighting, going back to 74, some of those crises that took place. And throughout all of that, really, markets were resilient, and essentially the title kind of says it all, right? They rewarded discipline of staying invested, not staying in your seat, staying the course, rather than trying to time markets around these types of events. Any questions or comments on that? All right, I'll go into concentration risk next. And I think right now, with where we're at in the US markets, and even abroad, I mean, you have Korea and Taiwan, much of their stock markets are made up by 1 or 2 stocks. So it's not just necessarily a US-centric theme, but it certainly is pretty heavily talked about in the US markets. So all we're doing here is looking at what percent of the markets are made up by the top 10 holdings in the US, basically and global markets around the world. And you can see in the US right now, we're above 40% for those top 10 holdings. And we've been growing that, right? We went from about 20% roughly, call it 15 years ago, to over 40% now. So you've just seen this kind of building of concentration in the United States market. Now, what's been driving this? If you go to slide 10, a lot of it's been, not surprisingly, the Mag 7. And this is really just more of an interesting illustration, I think, to put it into perspective, what the Mag 7 represent in terms of their weight relative to the broader markets. And so you look that basically the Mag 7 is making up about 20% of the ACWI, right? So basically the globe, versus the next seven biggest countries outside the US make up 21.5%. So these 7 stocks are as large as 7 countries, which I think is a pretty interesting fact, and something that I think, unless you've kind of seen this data, it may not be fully expected. So that's just really how large these have gotten, and what has been driving a lot of the concentration in the United States market. If we go down to the next slide, this is looking at basically earnings versus global market cap. And what we're saying here is that the Mag 7 make up 12% of the total global earnings, whereas their market cap make up, again, that 19-20% that we saw on the previous slide. Meaning that their growth has, a lot of it's been kind of valuation expansion rather than necessarily their pure earnings growth driving that market cap weight. So we've seen that expansion in the US, and we'll talk a little bit more about that here in a minute. But really just trying to drive home the point that a lot of that concentration has been built off of expanding valuations among very few securities in the US market. The next slide is, I definitely don't want to try to make this seem as if we're making a prediction. As I stated, in the previous section, that's not the business that we're in. But we thought it would be interesting to take a look at something that might draw somewhat of a parallel to what we saw during the dot-com era. And what we're looking at is the 15 stocks that contributed the most in terms of the return to the markets back in 1999, just prior to the tech bust in 2000. So many household names: Microsoft, Cisco, Oracle. And then looking forward 5, 10, 25 years to see which ones of these stocks were actually able to beat the return of the S&P 500. So S&P 500 in that 5, 10, 25-year bucket are highlighted in gray, the returns for them. And then anything above that outperformed the S&P, anything below it underperformed it. So going forward, even though I think in 1999, these would have been probably many of the companies that people would say were going to kind of basically be the beneficiaries of the dot-com boom, and only 2 of them over a 25-year period, those being Microsoft and Oracle, were actually able to beat the returns of the S&P. I think really going further to the point of prediction is hard, and to predict today who the winners of AI are going to be is a very difficult task. We're actually doing this again for just the telecom sector. This is just the tech sector. And it's interesting to see a very similar outcome for telecom of the companies that kind of really built the backbone of the internet, and how many of them had a very big struggle going forward after the tech bust, excuse me. So again, not to make a prediction, but I think just an interesting point of, it's so difficult to tell who is going to win the AI race, which leads me into the next slide of 13, where we try to stress to clients that, and not that you're trying to chase returns of just AI, but that AI is all around us. And so this is representing what percent of US equities are defined as AI by different AI ETFs out there. So ETFs that are labeled artificial intelligence. We're looking at those holdings and what percent those holdings represent of the US equity market and the global equity market. Driving the point home that, you don't have to guess which ones these AI companies are going to be the winners of the AI race. You're already exposed to a pretty significant portion of your equity allocation, in all likelihood, if it's broad and diversified, to companies that, should benefit from the advancements in AI. All right, next up is international diversification. I think we'll probably have time for both of these, international and EM. So this is really going to the point of, how can you combat some of that concentration risk that we're seeing in the US market right now? Diversifying internationally is certainly one way to combat that. So, not only does it make sense from a concentration risk perspective, but I want to drive home the point too that the US is not always the best performer out there. And so what we have here is in gray, the range of country returns going back to 1972. And then you've got the blue line, which is the US market. And so you can see that really we're not always going to be the best performing country. So to have that diversification globally not only helps you from a concentration perspective, but also from a return perspective, where you're going to capture the returns of those, large returns, like in 2006, where we were toward the bottom of that, band of country returns. Shown a different way on 16, these are the next two are what we call our quilt slides, and they're meant to look like kind of just this patchwork quilt. And what they're showing is the best return to the worst return, keeping the color coding for every country over the last 20 years. And I know it's really small, so it's hard to see, but so for the US market, it's kind of like a royal blue, and it was only the best performer once over the past 20 years in 2014. So just kind of further that vein of speaking about difficult to say which country will actually be the best performer. The next one is very similar, but just for the emerging markets, again, a very randomized pattern. Both of these going to the point that, right, it's best to have a broad diversified portfolio, really having exposure to all countries, so that when one of those countries is the best performer, you should be getting your, kind of rough allocation to that return. The last year is a great example of that on the next slide, where we've seen emerging markets on a tear. Specifically, Korea has had an incredible run, much of that driven by a few securities, Samsung being the main one there. But again, if you weren't allocating to EM, and I know you all are, you wouldn't have gotten that same country return from a Korea like we see here in this. And the US is kind of down to the bottom third of that on the right-hand side. Below that kind of 20% mark. One other question that we get, or kind of comment that we get from some clients, is on, well, I own, let's say, a lot of US securities that are very global in nature, and they get their revenue from many different countries. So isn't that kind of my international diversification? So if we go to 19 and we take a look at this, we put this together a couple years ago. And it's looking at different signals. So basically on the top chart, we're looking at months when the non-US markets, so developed ex-US markets, had a negative return. What did US markets do just below that? Then what did US firms or companies do that had foreign revenue versus US companies that did not have foreign revenue? And what you can see is that really US companies, whether or not they have that foreign exposure, pretty much return the US market return, and look very different from developed ex-US markets in times when there are opposing signals, essentially, when developed ex-US is negative and US is positive. And below that, we see the same thing. When US markets are positive, when developed ex-US markets are positive, then US markets are negative, and it doesn't really matter whether or not those firms in the US have foreign revenue exposure. So driving the point home, and this is backed up by academic research, that really country returns are more driven by where they're listed, right, where they're actually traded, rather than necessarily their revenue mix around the world. So in order to have that kind of true international diversification, we find that you need to actually invest in, not just companies in the US that have foreign revenue, but companies listed abroad that have true non-US exposure. The last thing I'll touch on diversification is, if you diversify, you are able to also diversify away some of that premium that we're paying in the US market for companies. Now, granted, they are very high earning, but still those earnings are paying a multiple in terms of that PE ratio, which we're seeing here in the US market in blue, compared to developed markets and emerging markets below that. So you're able to kind of get a little bit of a reprieve from the steep valuations we're paying in the US by diversifying globally. All right, lastly, emerging markets. Hopefully this is helpful, but I thought it'd be interesting just kind of show the evolution of emerging markets and kind of make a bit of a primer on it. So first off, kind of where do EM markets stand today? And we'll see that, China, as it has for the better part of probably 20 years, is leading the pack, followed by India and Taiwan. But this position of dominance has been challenged in recent years, which we'll see in a few slides. But I think before we go there, if we take a step back and say, well, who decides if a country is developed or emerging from an investment perspective? And I think one way to look, or one way to start, is to look at indices And you'd think hopefully there's some consistency there to define what an emerging market is. It's interesting though, if we go to the next slide, some of these indices actually disagree. And on this one, again, another one of those quote slides, we tend to like to, to make this kind of an illustration, but we're looking at different indices, right? We're looking at FTSE, S&P, and MSCI, and we're looking at the returns over the 20-year period. We'll focus on that bottom row, which is just emerging markets. And you'll see quite differing returns. In any given year, you can have 4% difference in returns among these different benchmarks, which again are all emerging markets benchmarks. But the reason that we see these differences, one of the main reasons, is what countries are eligible for emerging markets versus developed. The biggest thing here is probably Korea. So MSCI does include Korea, while FTSE and S&P do not. So FTSE and S&P versus MSCI have differing opinions on where Korea should be. And the results, again, are pretty large, an average of a 2.7% difference on any given year. So the question is kind of like, who is right? What makes an emerging market an emerging market? So if we go to the next one, these are some of the criteria that we think are reasonable to really make that delineation between an emerging market and more of a developed market. Now, we side with MSCI as Korea being an emerging market. The main reasons are really the availability when you can trade their currency, when you can trade in FX markets, which for them it's only during market hours, so it's a bit of a liquidity concern. You also have kind of a regulatory track record with Korea, particularly in terms of their short sale bans. They tend to be pretty quick to put short sale bans on in times of distress. So they had short sale bans on their securities during the financial crisis, during the pandemic. And that for us, we think that the ability to short really leads to more efficient and transparent markets. So those are really probably two of the main reasons that we feel and MSCI feels that Korea should still be an emerging market. But these other considerations are certainly ones that we think about as well. All right, if we go down to the next one, and I know we have probably 2 minutes, so I'll try to be pretty quick here. But this is going to be EM's share of kind of global market cap since 1990. So you can see really in 1990, it was barely a blip, right? Hardly anything in emerging markets back then. Then you kind of see that large drawdown in 97, 98 for the Asian financial crisis, and then the Russian financial crisis in 98 as well. And then you had this impressive run right after up until after the GFC. China's interesting. It was only about 1% of the EM back in 1998 when EM really started to take off there. It's really been less of a performance story, though, and kind of an evolution in the opening up of China's financial markets to global investors. The invention of H-shares, A-shares, Stock Connect, basically those are different ways for foreign investors to access and tap the Chinese market. And so it's kind of been more of their growth rather than just purely from a performance perspective. And this has been really, counter to the growth of some that have dropped off. So Venezuela and Argentina in 06 and 09 respectively dropped out of emerging markets due to troubles that they had within their economies. And you've had some countries that were really big at once really fall down. So Malaysia, for instance, in the late 80s and through the mid 90s had a weight of 30% in emerging markets. It's since fallen off significantly from there. Mexico had a run in the early 90s when it was about 30% of emerging markets. So it's really a volatile kind of market in terms of the country weights that are going to evolve over time. And in a couple slides, we'll kind of see a little bit more of that as far as what it's looked like more recently. Let's next one is here where EM stands today. So US is about 62%, emerging about 12.5%, and then developed markets make up the remainder. And then on 27, we just kind of go into over the past 20 years, what it looks like 10 years, excuse me, in terms of how markets have evolved. What we see is that, again, China's weight kind of benefiting from the opening up of its markets in the late 2010s. And then they kind of built their dominance, reaching a peak of about 40% in October of 2020. Then we had a time not too far after that where India did overtake it just barely a couple summers ago. And now we see that Korea and Taiwan are starting to really challenge and have very strong returns more recently than this, and challenge again that dominance that China's held for, the better part of 10, 15 years. So just a kind of a background on EM and the evolution of it and how it's defined. Hopefully that was informative. But any questions on any of these topics, I'd be glad to address them.
No, that's great. Very, very helpful. So if there's one takeaway from it I got, and correct me if I'm wrong, it's that diversification is the way to go.
Yeah, diversification and sticking to your guns, right? Staying the course in terms of the investment philosophy that you've taken on, rather than trying to change your stripes. I think at any point, it's such a difficult game to win.
Right.
And if I may, Jeff and Gwelda, can I say a couple of quick words by way of introduction? Because we didn't do introductions, and I know we're 30 minutes in. So in the endorsement of Gavin as an expert has clearly been illustrated through the conversation. But I know we're going to get into the portfolios here in a moment, and so just wanted to say very quickly. My name's Kevin Brown, and I've met Sue a number of times. I've actually met Dr. Sanders at the Mo Mapers conference. I don't know if anybody's going to be there this summer, but the last couple of years I've had the opportunity to visit and always enjoy that, and would look forward to seeing anybody who is there. But I'm a regional director, cover a number of clients in the state of Missouri, proud to do so. And I have been with Dimensional for just about 3 years. And my role is to provide you with anything that you need with respect to Dimensional, including something just like this, which is frankly a joy to be able to bring you education. Because we don't often get to do that. Oftentimes it's, let's just talk about the portfolios and then on your way. And there's so much more that we can offer. And ideally, you were able to get a glimpse of that, covering a broad variety of topics. But Jeff, I think that you really hit the nail on the head. Bottom line, just like your entire portfolio is diversified. And so I think that was a great way to summarize it, Jeff. And so I'm going to make a quick introduction to Gavin as he pivots into the portfolios in just a moment. And so I think the real interesting thing that you got to see from Gavin is, first of all, he's been with Dimensional 13 years. So Gavin has an incredible perspective because Gavin has been a portfolio manager. In fact, he was a portfolio manager in the microcap fund for which you hold. And so he's about to describe and share with you a lot of information about the microcap fund. But as individuals, some individuals stay and stick with portfolio management just by choice. And the cool thing about Dimensional is there are multiple avenues. And so Dimensional is an organization that you'll see here in a moment that spans a lot of different asset classes, and individuals who have really a special ability to communicate the stories of Dimensional, similar to what you just heard, just by way of education. But now you'll hear it in context of Dimensional, are people who are in our investment solutions group. And so that's where Gavin sits today. And so most of the individuals in the investment solutions group have portfolio management backgrounds. It's very challenging at times to be able to illustrate and tell those stories. And so I think it's a real treat to have Gavin on, and you've already heard it. And so we'll just pivot straight up into the document here today. If we want to bring up the second, if that's okay with you all, the second document. And let's go ahead and fast forward a slide here. And I'm just going to say a couple of quick words, one more slide to the next content slide. Okay, perfect. right here. So the only thing I want to communicate here, and we'll be incredibly brief, is that Dimensional remains at 1,600 employees strong. And you see something that says 969 billion in assets under management, March 31. We have eclipsed $1 trillion in assets under management. And like my father always says about doctors and things, it's only a matter of how does it benefit me? It's great that, things are going very, very well in terms of the assets are growing, the markets are continuing to grow, and we have a lot of inflows in a variety of different strategies. But importantly, you're going to hear how things have gone in the strategies that you've chosen to invest in, which just to give you an idea, they've gone very well. So excited to talk through those here in a moment. But and important also, Dimensional is a research-based or originated organization. And so staying up the recently published information is very, very important to Dimensional. And we have an entire group dedicated to research that's not just about backing the philosophy and process that we currently use, but just like you all do on an everyday basis, you want to test and challenge those things, make certain that they continue to work, evolve, and change if they are not, or if you find new and interesting ways in order to incorporate new ways to do things that are potentially better. And so we do a lot of challenging at Dimensional. And so we can go ahead and move to the next page. And the most important thing remains one investment philosophy over 45 years. And Gavin will touch on these things, but size, value, and profitability, and you know those well because you're in a microcap portfolio, small cap, and you're an emerging markets value portfolio. And so you're taking advantage of what I would call the bread and butter of what Dimensional does. And let's go ahead and pivot to the next. And we can keep going. You've been a client of ours for a number of years. Here, I did want to stop here just a moment. Of those 1,600 employees, I did want to comment that we have our Chief Investment Officer role co-divided between Gerardo Riley, who you see on at the top of the page there, and Savina Rozova. And of course, Chief Investment Officer is a very important role. And so with that being subdivided, it's also allowed the research group, who in the past was led by Savina, for Wei Dai there just to the lower left, to be the head of the research group. And so what we have done is split the CIO role so that it can be thoroughly covered, as well as named an independent individual head of research that I mentioned a moment ago is so critical to the founding and ongoing evolution of Dimensional. And so then there are a number of individuals that you see pictured here who are the heads of various different areas of those departments. And we can go ahead and fast forward. And lastly, all I'll comment here on the last 60 seconds is I just want to point out that what you likely already knows, and what I've stated a moment ago, is that we're very well diversified in a number of different asset classes. And of course, the asset class that you're most interested in here is the micro cap, which is our longest standing investment option. That was the first fund that Dimensional created back in 1981. And you'll see it there at the bottom of the US equity piece. And then, of course, you have an emerging markets fund, and you see the emerging markets area just there to the right, all of which have grown significantly over the years. But most importantly, we've been able to maintain the investment philosophy and process steadfastly. And that's what you want: consistency. Consistency is the key. And staying the course, as Gavin communicated a moment ago. So with that, I will stop talking and turn it over to the real expert that you really want to hear from, which is Gavin, on the portfolios, and talk about how things have gone over the last number of months and years.
Great. Oh, thank you, Kevin. Very, very generous. So I'll start on slide 11, I think it is, hopefully in the deck as well that you have. And so really briefly, and I think this probably came through in my comments earlier and Kevin's comments, we're quite a bit different than a traditional active management type manager, or even an index as well. Indices, obviously, their main goal is to give you an exact market cap weighted representation of whatever segment of the market you're trying to capture. Compare that to stock pickers, where their stance is that they kind of are able to outguess the markets. Our stance is that we want to work with the markets, starting with a broad market cap weight perspective, but then just tilting the odds in our favor a bit and focusing more on these academic premiums that we've identified, as well as pairing with academics in the community to find, being smaller companies, value companies, and companies with higher profitability. And we'll see that when we go into the EM Value Fund. But really just taking a market cap weight, and as the picture is trying to depict, putting weight into those kind of darker circles there and taking a little bit of weight away from those lighter circles. So darker circles are going to be representative of smaller value-oriented companies with better profitability. Lighter circles are going to be larger, less profitable, and more growth-oriented companies. So a bit of a different perspective of, really, for us, it's trusting market prices and then tilting a little bit away from them, rather than traditional active of really just trying to go in and thinking as if you can pick and choose the winners and losers at any given time. If we go to 12, this is really kind of our daily process of thinking about, how do we actually add value every day when we come to market as a portfolio manager. Left-hand side are going to be the long-term. Really, these are going to be our steadfast, kind of evergreen approaches to capturing long-term value. That is, again, focusing on smaller companies, higher companies with better value characteristics, and higher in profitability. In the middle, over the short run, we're still going to focus all of our efforts on the long term. But over the short run, we know we can make some slight changes based on signals in the market to improve those expected returns. And a couple of those I'll cover in a few slides are securities lending and our momentum screens that we apply as well. Lastly, on the right-hand side, when we go to market on an intraday basis, so we do trade every single day in the markets. We're not waiting for anybody to signal to us or tell us when to trade, but we are rebalancing a little bit. I would say, 5-10 basis points a day to kind of make up that overall annual turnover number. But the key here is that we are looking for characteristics of securities. So we don't have to really buy or sell any given stock on any given day, but we have so many to choose from. So for example, in the microcap fund, if I would have received, say, $10 million of inflows today, I would create an order set that's worth maybe, say, $30 or $40 million and provide that to my trader. Every one of those stocks I do want to own, but I'm agnostic to which one of those I own today versus which ones I own tomorrow or the next day. So my trader can take that when she goes to market and really trade very selectively and only in those stocks where we're not the ones having to cross that bid offer spread, or at least we're having to maybe go to the midpoint rather than cross all the way over that spread. And so that's what we mean by kind of trading flexibly and having those substitutes. So we can walk away from a trade in one stock today because maybe we would have to cross that spread and pay that cost to trade. And then we'll come back tomorrow and maybe try to buy that stock. So anything we save in that bid offer spread, which we don't have in this deck, but it's a significant percentage of those average spreads, that savings goes right back to the fund. And it's something that's not really maybe listed anywhere, but we think it's a big value add, especially in a fund like microcap, where those spreads tend to be wider. And it's been an asset class that we've been targeting for 45 years. So it's really been since the beginning of the company. We knew we had to trade very efficiently in that range of the market in order to not impact prices and not detract from our returns. Slide 13 is, I think, a nice just visual representation of really what we do within the small cap market. Oh, sorry, if you can go up just one more. Sorry about that. I must be 12. Thank you. Sorry, I have different numbers. So on this one, it's just kind of representing. So the gray dots are going to be representative holdings in our small cap fund or microcap fund. And then anything lit up are going to be ones where we're excluding. So the green area in the upper left, that's the intersection of high growth stocks and very low profitability. And as we'll see on the next slide, that corner of the market has much lower returns than the broader small cap market. High asset growth is a little more sprinkled throughout, but this again is another exclusion that we make that has significantly lower returns than the broader small cap market. The securities lending and downward momentum, I'll cover those in a moment, but again, those are more sprinkled throughout. And those are more of kind of daily exclusions that we make rather than evergreen. So every day we'll look to see from a sec lending perspective are the ones we should exclude. Same thing for downward momentum. For securities lending, so primarily why we lend is to generate revenue for the funds, first and foremost. But secondarily, what we do is we collect a lot of information from the market and from our lending agents. And what we find is that when the market is willing to pay up to borrow a stock, over the short run, those stocks tend to have lower returns than their broader cohort. So what we'll do is right before we trade, we'll say, well, if that one has, again, higher borrowing costs, we'll wait to buy more of it. So it's really more of a delay mechanism than, increasing turnover. And we'll come back every single day and apply that same exclusion right before we trade so that we're not buying more of these stocks that, from the data perspective, we see have lower expected returns over the short run. And momentum I'll touch in a moment when we get to that one. The next slide shows us what, I apologize. You can go back maybe too. Sorry about that. One more, sorry. One after this one. There we go, thank you. This is really just the data behind those exclusions. So the left-hand side, we have the whole small cap market and what the return has been historically. Then we have the small growth, low profitability exclusion. And you'll see, we'll just use the US as an example. It has about half the returns of the broader small cap market, about 6 and change versus 13.79. Then the small high asset growth at 2.5%. And then finally, the right-hand side, what we're doing is if we control for those two center columns, then we can take that 13.8% and increase it to about close to 15. So about a 1.2% increase. And the interesting thing is we're only excluding about maybe call it 10 to 12% of the market, but we're able to achieve that 1.2% annualized outperformance. So I think a really powerful result for just controlling for a pretty minor part of the small cap market that tend to have quite low returns relative to the broader small cap market. We can go on to momentum on the next one. This one has both securities lending and momentum. So momentum is another one of those right before we trade type exclusions where we look just on a relative price performance basis. If a security has negative momentum, meaning it has really the worst 5 to 10% in terms of its cohort's momentum, then again, we'll kind of wait to buy more of it until that momentum has subsided. So another one of those short-term exclusions that we're just helping on the margin, but we want to make sure that if there's data that points us to something we should be doing in the portfolios, whether it's long-term or short-term, we certainly want to apply that and capture that expected return. And then lastly, on trading on the next slide, we really talked a lot about this already. It all comes down to those implicit costs. Turnover helps, lower turnover helps, but those implicit costs on the right-hand side are going to be well in excess of any kind of a commission you're going to be paying for a trade. And that substitutability and that flexibility that comes into the process are really what drive us lowering those implicit costs to trade. And the right-hand side is really just the proof from a third-party vendor showing where we rank relative to the median peer in terms of our costs to trade. And you can see those bars toward the bottom where Dimensional is at, below that probably 10th percentile right there at the bottom, compared to those median circles there in the midpoint. All right, I know we have 10 minutes, so I'll try to jam through this. Do you all have a hard stop at 5:30? I just want to be respectful of your time.
Yeah.
You do? Okay, gotcha. All right, so I will go past this one. Basically, Q1 was tough across the board. Q2 has been much better. US market's up about 14%. Developed outside is up about 9%. EM's up about 21%. So Q2, very strong start despite the rough start to the year. On the next slide, in terms of premiums for the US market, what we saw is there was that size premium. And so that was beneficial for your microcap fund, which we'll see as the R2 has kind of drifted away from that micro small cap space and allowed some stocks to float up above that kind of definition of small caps or microcaps. Value was positive as well, and prof was positive too, although not so much in large value. But again, we'll see that size premium come through in the microcap fund. And then the next slide for emerging markets, kind of more of the market segment returns again. We saw a negative size premium, kind of a mixed value premium, but there was this profitability premium within large value, and we'll see that kind of come through in the returns too. If we go down to what the portfolio can buy 2 slides from here. This is the microcap fund. And what we're doing is we're starting with the entire US market. We don't want to let any index or anyone define our kind of area in which our opportunity set. We make that first cut on 5%. Right now, that's about 5 billion. So that'll be our kind of ceiling for investment. And then we'll go down below that. And really the main difference is showing up to the bottom right of that, where that starburst is that area. We talked about that, those green dots, that small, low profitability exclusion. That's going to be that white starburst, right? So the intersection of very growth-oriented stocks and very low profitability that have those lower returns on an annual basis. That's going to be the main exclusion. We're also making that high asset growth exclusion that we mentioned on a few slides ago as well. And then we do cut REITs out. That's really standard across all of our equity portfolios. It's really more of allowing our clients to make that asset allocation decision separate from their equity allocation decision, as REITs do tend to perform a little bit differently than equities. So that's the setup. The next slide is really just showing the benefit of making that that low profitability exclusion. So anything above the line on an annual basis is going to be a benefit for making that exclusion. Anything below the line is when that was a detriment to performance. But you can see most things are above the line, but certain times we know you can have this kind of what I'll call a junk rally happen. And that can happen certainly, but on average, it's definitely expected to be a benefit for the portfolio. If we go to the next one, you'll see that we're going to be a little bit smaller. The Russell 2, just by its own definition, is a little bit larger than we are. So we're a bit smaller, going deeper in that microcap space. We're going to have a lower price to book and a higher profitability, really based on the fact that we're making that starburst exclusion in terms of those more growth-oriented stocks that have low profitability. The next one, in terms of sectors, you can really see that high growth, low profitability exclusion show up in the underweight to healthcare, right? Tend to be a lot of biotechs in there that fit that exclusion criteria, excuse me. And then IT as well, again, one of those that tend to be lower in profitability and higher in growth. So you'll see a lot of the differences there. We'll then take that weight plus the REIT and reallocate it across the other sectors, which will lead to overweights in those really.
Join Jack Dole at Profession.
I'm sorry.
I'm sorry? Okay. So that's really going to be the main differences you'll see from a sector perspective. Next up on performance, we have the long term on the right, the short term on the left. This is going to be net returns back to our investors. Long term, about 1.5% annualized outperformance, which we're really proud of there. Q1 also really strong. We were up 4.2%, excuse me, versus about 90 basis points, so about 3.3% outperformance, really driven by, again, I kind of mentioned there was that small cap premium, micro cap premium, where the R2 drifted up a little bit, got a little bit larger. So our everyday rebalancing helped us to stay in that micro cap space, and that was beneficial as we saw that micro and small cap premium come through. Profitability was also beneficial, where companies with low profitability underperformed, and therefore our exclusion of those was beneficial to returns. And then lastly on this portion is really just kind of showing that overall track record and growth of wealth. This is, again, the fund that Kevin mentioned we started in 1981. So again, just really proud of that track record going back about 45 years and seeing that excess return relative to the Russell 2. Any questions on microcap? Oh, great. I'll jump over to EM value. So similar to the US one, we want to start with the entire emerging markets. We don't want to, again, let an index confine us to what universe we can invest in. We're then going to make this kind of delineation there you see on that left-hand illustration of large cap versus small cap. And we're making that at the 15% level. So above 15, we would define as large cap. And from there, we'll then expand out to the right. And from there, we're going to have an overweight, underweight schema for value, size, and profitability. So again, kind of similar to that dot plot we had before, we're going to increase our weight in the darker shading area of that pane, of those panes, and then decrease our weight to the lighter shaded areas of those panes. So leaning into smaller companies with better value characteristics and higher profitability. Then below that line on the left-hand side, we're going to expand down to the bottom. Within small caps, we do this through more of an exclusionary perspective. We don't want to put too many multipliers or overweights to the small cap market just because it can be a little bit tougher to trade. So we don't want to kind of make that any more difficult by increasing the weight there significantly. So we don't tilt. But we do make that kind of hockey stick exclusion that you can see there on the bottom graphic of cutting out kind of the worst offenders in terms of profitability. And then over on the right-hand side, when they get to be a little bit away from value, we'll be even a little bit more selective and cut out about half of the ones of that little hockey stick area on the right-hand side. So from there, we are going to also make that high asset growth exclusion within small caps. But for emerging markets, it's pretty small. So I wouldn't say it's too impactful. We'll take REITs out as well, but it's a much smaller part of the market than in the US, so not as impactful. And then within all of our value strategies, we do exclude highly regulated utilities. This is due to the fact that those utilities tend to not be able to set their own prices. They tend to kind of look like value stocks because they have depressed valuations, but from an expected return perspective, they don't show up the same as a value stock would. So we do make that exclusion too, which is about 2% relative to the value benchmark. The next slide in terms of characteristics, much more diversified than the benchmarks with significantly more holdings. The benchmarks tend to be large cap benchmarks, so they really only play in above that 15% range that we saw on the previous slide. So we have basically 20% of our holdings in small caps or a little bit more than that. The benchmarks wouldn't really have much weight there at all. We're going to have a lower market cap because we go into small caps and we tilt into those smaller securities in the large cap space. Will also be deeper value given the tilts. Now, lower profitability on the right-hand side is expected because given how much smaller and more value-oriented we are, profitability is basically negatively correlated with size and value. So the smaller you get, the more value-oriented you get, you tend to have lower profitability among that set of securities. So we are tilting into profitability, but given, again, our lower size and deeper value, we still come out a little bit below the benchmarks in terms of profitability. In terms of sectors on the next one, one thing I'll stress here is, this is really an intentional result of construction we talked about and daily rebalancing. So similarly to timing the markets, we're not trying to time sectors. It's really going to be that intentional result of where we see value within the universe. Here you'll see financials are underweight versus the value benchmark. One thing we do from a risk control perspective is we want to make sure that any given sector is not more than 10% greater than kind of the broad market-wide segment. So for instance, financials right now are slightly capped. We're at about 30%. The broad market is at about 20% roughly in terms of financials. So we're going to cap it at 10% above that kind of style neutral market, if that makes sense. Again, just a risk control measure. We saw during the financial crisis, especially in the US market, if you didn't cap value strategies, you would have ended up with 40, 50% in the financial sector, which is just too much concentration risk. We'll see in IT, we're going to be underweight due to our deeper value cut compared to the benchmarks. Overweight materials, industrials, mainly due to our small cap inclusion. And then right now, a bit overweight energy given the value tilt there. In terms of performance on the next slide, again, same setup, far right long-term, short-term on the left, about 2.8% basis, 2.8%, excuse me, annualized excess returns, net of fees going back on the far right-hand side versus the value benchmark, and really strong across the board. Q1 on the far left, up 3.6% relative to 1.1 for the benchmark. Really, again, we kind of saw this in the market environment, but those higher prof stocks within the value universe were really beneficial for the quarter. And I will say, I don't know how much you all have talked about fair value, but that is something that does impact non-US portfolios. So we do fair value our mutual funds, which means that we'll take the closing prints in the local markets, and then we'll look at what the US market did throughout the trading day after those markets close. And if the markets in the US went up, say through an ADR that represents a stock maybe that we hold, but there's a process that we go through with our custodians and our fund accountants. But in essence, we're going to increase the value based on what the US market did. Benchmarks don't do that. They just go purely on the local close. So for that reason, we also were benefited a little bit in Q1 from that fair value adjustment. that's really just an endpoint dependent thing. It's going to snap back the next day, but I did want to mention it because it was beneficial for Q1 in addition to the higher profitability value stocks.
I think
All
we're
right, I
right
made
at
it.
it.
Any questions?
I had one comment. Just
Yes.
wondering, how are you feeling about going forward with emerging markets? I mean, emerging markets has had a pretty good, very strong run last year and so far this year. So what's your
Mhm.
outlook? What are your feelings? Have we hit the
Sure.
top?
Have we hit the top? Yeah, I would kind of go back to some of the comments that I made early. It is so difficult to predict whether it's broader markets or the premiums going forward. So for emerging markets, to your point, they've had an incredible run. I think going back to the valuation chart that we had on the previous deck, you still see that they're somewhat undervalued relative to the U.S. market. Now, I won't say that that should be predictive. So we've tested that. We've looked to see, do differences in valuations mean anything going forward for the premiums or markets? We don't see that that really has any explanatory power. So hard to say for us. I think we're not ones to say change your allocation based on recent performance. I think you need to be comfortable with your allocation to whatever asset class it might be. And strong performance doesn't necessarily mean that you're going to see weak performance going forward, whether it's U.S. emerging markets or any market. So I guess long-winded way of saying we don't have kind of a house view on whether emerging markets will continue to outperform, but they've certainly had a nice run, and I would say maybe made up some ground relative to the U.S. The U.S. has had a run for 10, 15 years. And EM has kind of had a nice bounce back over the past year, call it year and a half.
Okay, all right. Are there any questions or comments from the committee? Or Jeff, do you have anything you want to add?
Girl, my head hurts learning about all this micro cap stuff. I don't know about anybody else, but I'm like, I try to follow. But, and forgive me, so are you a quantitative shop that selects through models and then do a top down or a bottom up?
I would say, yes, we're a quantitative shop, but not, when I think of quant, I think of somewhat opaque premiums that you're trying to capture or signals that you're trying to capture, a traditional quant. So I wouldn't put us in that camp. I'd say we're more of a systematic active where we've identified these core premiums that we always focus on: size, value, profitability. We do those things around the edges on the short term, momentum, securities lending, but we're going to stick to those very loyally over time and not shift among them. And so, yes, we're quantitative in the respect that we're not taking an individual stock and coming up with our own best estimate of the value of that stock. I would say we're kind of leveraging the research broadly that the market is doing, and then looking to that to then weight portfolios. So if the market is valuing a stock at value stock, and we have strong research to support that value stocks should outperform growth over the long run, then we're kind of going to trust the market and say, okay, that's a value stock based on the overall market's valuation of that security. Therefore, we're going to put a little more weight in that value stock than one of the growth stocks. And
So,
very consistent over time.
I know you've mentioned this a couple of times when you say the valuations and then the securities lending. We have a lot of new
Yeah.
trustees on the board
Oh,
that
yeah.
do not understand that. So can you
Okay.
just explain that? Because that's something that I've heard throughout the whole presentation,
Mhm.
to explain what that looks like and what it means.
Definitely. Sorry about that. Yeah. So a value versus a growth stock, it's really price divided by any kind of fundamental metric. So you could use price divided by book value. You could use price divided by earnings, price divided by cash flows or sales. And so essentially anything that has a high ratio there, we would define as a growth stock. Anything that has a low ratio there, we would define as a value stock. And those things mean different things to different shops because you can draw that line of the delineation between the two at any point. We kind of like generally think of value to be the bottom third of the lowest price to whatever you want to call it. We use price to book. So that's really that delineation between value and growth, seeing that value tends to outperform growth over longer periods. And so easy examples would be, JP Morgan Chase, that's going to be a traditional large value company. Tesla is going to be a traditional large growth company, right? Very high valuation, very low profitability. JP kind of on the other end of that spectrum.
So I'll give one. Can I give one quick example of that for any
sure.
new trustees? And probably laugh at this, but SpaceX obviously is, is on everybody's mind. So when you look at the book value of SpaceX, what does that mean? It means the value of that company, of SpaceX, if it were to have to get liquidated today, is a simple way to say it. You look at the financials and you say, okay, well, what's the company worth? Is it worth $1 billion if they have to sell all the assets and go into bankruptcy, or is it worth $1 trillion? So the price of the stock, as we all know, is today, what, $200 a share-ish, right? And so its value, the valuation that we keep talking about is, okay, valuation. That's the stock price times the number of shares outstanding, which, SpaceX is worth $2 trillion. But if it went bankrupt today, right now, it's worth what? 30 billion, 50 billion, something like that, guys. So people are willing to pay a dramatic amount, hundreds and hundreds of times more for that stock than it's actually book value worth. And so, boy, it's got to do real well going forward, because the expected cash flow on its sales and things better be awfully good to justify the value. And so it's very interesting. And we look at those things. That's how we evaluate. Wow, how big of a bang for the buck are we going to get? And we want our investors to get a very big bang for the buck. So SpaceX, not exactly our cup of tea at the moment. I'll just put it that way, because we would view it as the valuation is very high for what the company's actually worth. But we'll see. Everybody believes in Elon, I suppose. Does that help a little bit?
Yes, it does.
And then did you want me to expand on sec lending? I know we're over time, but I'm glad to if it's helpful.
Yes, because that is something that's new to the trustees, and when we go to our training, we really don't get into the nuts and bolts of what that actually looks like.
Definitely. So securities lending is really based on the requirement from the SEC. So if a bank or a hedge fund wants to short sale a stock, they have to borrow that stock. They have to locate it, borrow it from a beneficial holder like a mutual fund or an ETF, take that, pay a fee in order to borrow it, and then they'll go out and short that security into the market. So as a beneficial owner, our mutual funds do lend out all of our securities to large institutions, large banks, JP Morgan, Morgan Stanley, Goldman Sachs, really household names. And then they'll then lend on to their clients, typically going to be hedge fund clients. So in return for that loan, we receive a fee back from the bank. And then that fee goes directly back to our clients or our mutual funds, which is to the benefit of our clients. So that's kind of the general transaction of us to the actual loan itself. I guess in terms of kind of return to the funds, it's going to vary significantly based on the asset class. So for US microcap, I think we're probably right now around between 5 and 10 basis points a year in terms of the revenue generated back to the fund from lending. In emerging markets value, it's going to be probably closer to 15 to 20 basis points. So it's a little bit more. Emerging markets tend to demand a higher fee for that borrow cost. And in terms of how we, I guess, use it in our daily process, when those stocks get expensive to borrow, there's a lot of demand. That's when we kind of see that the short-term returns of those stocks tend to be lower than the rest of their kind of peer group. And so that's when we'll kind of stop buying a stock if it becomes, increasingly hard to borrow or expensive to borrow.
Okay.
So-
I
And-
can definitely
and
expand
Chris-
more, but
Yeah, Christina, at the risk of muddying the waters for everybody too, just a couple other things on that to talk about, because for a mutual fund, you're probably going to find by and large that many do that. You can certainly go out and find ones that
Mhm.
don't. Now, when it comes to our commingled investment trusts, again, that can be a bit of a mixed bag. Some providers, some managers will say we have a class that doesn't do securities lending, some do. Others will just say, no, we're always going to do it. And then you get to the separate accounts where you all have the decision to make it, part of their process to say you can do it or you can't. So, I mean, in general, we've allowed it whenever we've done a commingled fund. We've said, go ahead and do it. But again, just so kind of everybody knows why some boards of trustees, and we've had clients that have gone through this before, said we won't do it for certain reasons. Number one, the biggest just being back in the day, there was kind of a collateral issue. So the collateral, when they're doing the securities lending, that money has to go somewhere. And that's where the return gets generated, as on that collateral. So there were some issues on that collateral going bad. And so people had issues with that. And then the second being, when we were in an extremely low interest rate environment, there wasn't as much to be made on that collateral pool as well. So everybody said it's not worth it. But now we've been in this higher rate environment, and I think one of the things we do try to emphasize, and maybe Gavin can clarify this too for us, is you do a whole lot of work on understanding that collateral and make sure it's safe, and that all of that money is going to be there, and we're not taking undue risk by being in securities lending. That's just going to be additive for performance, as long as interest rates stay at a reasonable level.
No, the reason I asked Jeff is because being on this board so long, I know that our investment policies didn't allow it. And then we
Oh.
started allowing some of them. And so I don't
Right.
have them at the top of my head to be able to say, in what sectors. I don't know if we put restrictions, whatever, but I know that, we have addressed security lendings over the years. And I just wanted to let everybody know what that looks like, what it is. And, that is not something that would violate our guidelines, but we would have to just verify.
Correct. Good point.
To Jeff's point on the risks involved with it, I'll address those very briefly. But on the collateral side of the equation, that's going to be mark to market every single day. If it's a U.S. security, we require 102% of collateral mark to market daily. If it's a non-U.S. stock, to account for the foreign exchange movement, it's 105. So we're over collateralizing those positions. In the case that collateral is insufficient in the event of a default of one of those banks, then we have a lending agent that sits between ourselves and those large banks. They're contractually obligated to indemnify us for any shortfall in collateral. That has never happened. Even when Lehman went bankrupt, there was no shortfall in collateral. To Jeff's point, where people got in trouble was how they reinvested that cash collateral. They were investing it in commercial paper and other more risky products. We don't do that. We reinvest our cash collateral internally. We have a fund specifically identified that only makes our sec lending collateral investments. We keep that very short term, very high quality, and we really prioritize that over trying to get a higher return in that collateral, because it should be a very safe vehicle. So hopefully that expands on Jeff's points around the risks around it and our own controls around that.
Thank you. I appreciate it. Sorry for taking up more time.
It's important. And Christina, thanks for bringing that up again. And again, you and those that have been on the board for a while, if you recall, I think that might have been one of our first education sessions that Weld and I went through. We actually did a chart with the securities lending on it, and we can dust that off and do it again, because again, you're right. We've had a lot of new trustees and they haven't seen it, so I think it's a great topic.
All righty. We want to move forward, Jeff?
I think we're good, unless anybody else has questions for the DFA team.
Thank you both.
Thank you all.
Definitely.
We
Thank you so
greatly
much.
appreciate your business. Thank you.
Thank you.
Thank you.
Have a good one.
You too. Enjoyed your presentation.
Thank you.
Great. Thank you very much.
So I don't know if anybody else had thoughts or summarize. I'll just give it to a couple of quick bullets on them. First, just being on the quantitative watch list, both of, despite some recent underperformance, they still look good on our quantitative watch list. And as you saw from their numbers, their longer term is very good. And again, I think what they kind of went through in their education session, I think dovetails nice with just looking at some of that near-term performance and saying, well, this is kind of why they've underperformed, because there's things that do ebb and flow and have cycles. And this is exactly why we would say it's good for diversification. Some markets, maybe it doesn't look like it, but it is a real good diversifier in the portfolio. Each of those is roughly a 3% position in the portfolio, so they're not the biggest things out there, and they're also fitting specific roles, and they're again as being very good diversifiers within the portfolio. So I would say at this point, well, I don't know if you have any other comments, but it's still a manager that we recommend.
I'm in agreement with that. So Jeff, do you want to just make a few comments on the market environment, and then we can just briefly go through the performance for the month of May?
Sure. Sue, do you want to pull up the
Gotcha.
monthly with the market stats?
That the page.
Great. So this is going to be maybe a little repetitive of last month of saying, wow, look at all these great returns for the month of May, despite all of these things that are going on with the Straits of Hormuz and Fed uncertainty and economic uncertainty and all of these macro issues that are floating around. But nonetheless, the markets have been extremely resilient. So I think there certainly has been a good amount of volatility that's continued to be in the markets, and we're probably seeing a little bit more of that come out in June. But again, you take a look at some of these numbers, and it kind of masks the fact that there are some uncertainties going on out there. So the Fed just met, and again, they decided to keep interest rates where they are. So again, despite now having a new Fed chair, who I think everyone was a little concerned that he was gonna be towing the line of the president and be pretty aggressive now on lowering rates, and that's really not the case. I think they've really come out and just confirmed what's been going on for the past several meetings, of saying we've got a lot of moving pieces right now, and until we get a little bit more clarity on some of this turmoil in the Middle East and what all of this means as far as longer term inflation numbers. Again, we know there's short-term inflation. We know those oil prices are higher, and you can see actually come down a bit. I think when we last showed you that oil chart, and that's the bottom right table in this report, you can see where it's under commodities. It's the first one now at 87, and that was closer to 100 last time we looked at it. So those oil prices have come down, and they will continue to come down if we see what we've seen over the past couple of days, is that we're going to have a ceasefire that holds. We've got an agreement that's going to open up the straits. Expect to see those oil prices come down, and conversely see that inflation that's been driven by higher oil prices start to come down as well. So the gas has been still a little bit sticky. You see where that is right below it, still over at $4 a gallon. So certainly I think everybody that's filling up their tanks and gearing up for summer travel wants to see that number start to come down as well. So, but those have been kind of the sticky volatility points in the market. But nonetheless, if you see for the month, S&P 500 a little over 5%, and the small cap stocks a little too low, rows below that, not as good as the large cap stocks, but still pretty strong at 4% for the month. You see, we saw again some back and forth on that value versus growth for the month. Growth led again at 7% relative to value, which was just shy of 3%. But again, take a look at the colorful boxes just to the right of that. The one on the left are the year-to-date numbers for all the style categories, and you can see by and large the value for the year-to-date still leading across all of the capitalization. Maybe not so much in the small cap area, but in large cap, it's much more defined as to where that leadership has been. And again, probably expect that back and forth to continue, probably more to the favor of the value stocks as we see more of this trading and filing out of these AI and large cap technology stocks that have been really overvalued. And again, hopefully some of DFA's discussion on value and growth and how they manage portfolios helped everybody to visualize that a little bit in terms of technology and AI and all of those segments. So international, also another strong month. The developed stocks, which is the second to the last of that top box, the MSCI EFA, a little over 3%. And then they talked about it again, those emerging market numbers, which has been very strong. And again, you can see how much that can jump up and down at any given month. And that's the leader for the total month of May at almost 10%. So but it's a very strong return. We know they can be volatile. We know they can be down as much. And that's when we look at that overall structure for our portfolio, that we size it appropriately. That's why that manager in emerging markets is only a 3% position and not a 50% position in the fund. We know there's a lot of volatility there. But does add some nice diversification. And we certainly see it add to the bottom line when they have these very strong periods like we've seen. So for the past 12 months, where emerging markets are over 50%. So those are great periods to say we had some exposure there. It helped us diversify and did good things when other things weren't doing as well. So, but again, when you see something that can be up 50%, generally it can be down as much as that too. So we always want to make sure we're properly diversified and protecting that downside. So, but nonetheless, all of the categories for the latest 1 year, you can see it's just they've all been very strong, and they've been very good drivers of our overall portfolio and the system's return. And again, I think this I talked about it at the last meeting, but this really is a diversification market. This is a market that tells us why we want to have our eggs in a lot of different baskets, because we just, everything's kind of been good, but some things have been better than others, and it doesn't all happen in the same week or in the same month. And again, going back to those quilt charts that DFA was showing you, we just we can't time markets. We don't know when the emerging markets relative to a U.S. large cap growth is going to be good or bad. So that's why we want to have access in a thoughtful way to all of those. Fixed income right below, you can see, was a slightly positive month for the U.S. aggregate, and then the other areas of the market were not too far off of that. The corporate securities led the most for that period. On a 1 year basis, again, looking at the U.S. aggregate, a little over 5%, and that number continues to be really indicative of the coupon levels in bonds right now, where new bonds are getting issued. So if the government comes out and has a new issue today, or IBM comes out and issues a bond, they're going to be at these higher interest rates that we've seen. And certainly when the Fed comes out and says we're going to keep interest rates where they're at, that's pretty good. So that kind of keeps all of those levels at a nice high coupon for us that we're getting paid to lend money to the various factions out there, whether we're lending money to the government or lending money to a corporation or someone that's going out to buy a house. They're all paying us a real nice rate to use that money right now. So that's kind of what's going on. Again, we probably walk a little bit cautiously of saying things have been really good, but there's potential areas that if we see any sort of softness in the market, we can probably see a little bit of repricing. Again, we've probably seen a little bit of that in June, but the month's not over yet, so we'll kind of see where we go for the next couple of weeks in June. But again, we've seen nothing negative, and certainly from the standpoint of weighing positives versus negatives, certainly it starts to skew towards the positive side of the equation with getting some resolution on the Strait of Hormuz and what's going on in the Middle East. So I'll pause there and see if anyone has any questions on the markets. If not, Gwalda will jump forward on the rest of the report.
Okay, I'm gonna try to get through this without my internet connection dropping. And here, we're having bad weather here, so I'm having some, it may drop, and then Jeff will just have to shore me up. As you can see here, the fund is in compliance in all segments of the portfolio. So we're in compliance there. As you can see, the lowest is a global multi-sector, which we have done some adjusting in the in that area. Going forward, go forward, Sue. Here you can see the portfolio actually just slightly underperformed in the month of May, 2.24 versus 2.76. But the fiscal year to date numbers are basically in line with the policy index at 6.8 versus 6.8. And the 1 year number ending in May looks good, 17.8% versus 17.6. And the long-term since inception numbers are at 7.2, so above that policy index. The slight weakness that we see this particular month was in domestic equities. If you go down the page, you can see here Edgar Lomax, your value manager, underperformed this particular month. As Jeff mentioned, there's been seesaw back and forth between growth and value. Edgar Lomax is a deep value manager, and here they have a negative return. The 1 year number has been hurt by the most recent performance, but as you can see here, 1 year ending May, it's 25.6%. So a decent return, but this most recent performance during this quarter has hurt the performance of Lomax for the fiscal year to date. Below that,
Rhoda,
yes.
I'm going to stop you and tell you that you wish Bobby was here because she'd be praising you for positive numbers.
Yeah, yes. Yeah, not seeing any red on these pages.
That's right.
So, okay, on the large cap growth, as you know, TCW has been challenged, and we were able to negotiate a basic performance-based fee this particular, and so we're continuing to watch them on a month by month and quarter by quarter basis for improvement. But they're basically there's no fee until they start to outperform the Russell 1000 growth. This particular month at 5.6 versus 7.2. You can go to the next page, Sue. And the small cap, micro cap, and mid cap portion of the fund, as you can see, as a segment, they did not outperform. Each of the managers have their own challenges, Westfield, Systematic, and DFA. But what I will point your attention to is Westfield Systematic fiscal year to date are above the benchmark. DFA, they talked about their process. There's the below fiscal year to date. But if you look at the long-term numbers for each of these managers, we're not concerned with any of them. As you look at the since inception number for all of them, they have exceeded their respective benchmarks. So no real concern with any manager in that portion of the portfolio. Your developed international managers collectively outperform the EFA index. Fidelity is your growth manager under this particular month. Causeway International Value, the tilt, did extremely well versus their custom benchmark. If you look at the fiscal year to date number, you see the seesaw effect there, and the reason for having a balance versus growth and value manager. As you can see here, Fidelity exceeded, it's Causeway not so much. But the 1 year number for these managers and the long-term numbers for these managers are still strong. DFA did a good job in talking about what has happened with them. As you can see here, they had underperformance for the month of May, but no concerns really with this manager on a long-term basis. The shorter term numbers are below their benchmark, but still nice double-digit returns for DFA emerging markets. Exponence is your manager of emerging markets, emerging managers. This particular month, they actually exceeded the performance of the ACWI World Index in the month of May. As you know, we're watching this manager for continued consistent outperformance until the end of the year, and then we will make some decisions then. The most recent performance this month has actually brought the fiscal year to date number up above the ACWI World Index. You can turn to the next page, Sue. where we actually saw nice returns on a relative basis were in the fixed income segments. As you can see here, fixed income managers collectively deliver performance above the custom benchmark 0.54 versus 0.35. If you look down amongst the core managers, they were either in line with or above. The best performing manager in that core segment was your most recently hired manager, Loop Capital. And actually, they delivered performance of 0.47 versus 0.31. They were hired in July of last year. And if you look at the since inception number, nice returns over and above the Bloomberg aggregate at 4.7 versus 3.54. If you go down to opportunistic, all three managers did well versus their respective benchmarks of active managers. Loomis is above, Neuberger Berman has started to turn the performance around, and they're doing well. And Wellington, who's your most recent multi-sector credit manager, did very well in the month of May, 1.16 versus 0.35. And if you look at, since they've been hired back in November, 3.38% versus 1.1%. So fixed income really held up in the month of May and is doing well long term. The next page is your global asset allocation manager, PIMCO All Asset. Some weak performance this particular month, but a fiscal year to date, you can see there turns 9.0 versus 6.2. The 1 year number has also brought up some has been good at almost 20% versus 17.47. This is going to help pull up those longer term numbers. And as you can see now, the 10-year is since the inception number, they're above their custom benchmark. The other segment that did really well this particular month is in the hedge fund area. As you can see here, Whitebox and Grosvenor both exceeded their benchmark in the month of May, with Grosvenor delivering the best, much significantly better performance at 3.33 versus 2.60. And both of these managers have also done well on a long-term basis. So we've got just a little bit over a week left before the end of the second quarter. Hopefully all these things will hold and we will have a good fiscal year to date number, which is important when it comes to your actuary and meeting the goals of the plan. And I believe that's with all. Of course, we don't have real estate numbers. It's on a monthly basis. We'll have those things in the quarterly report that we bring to you in August. Are there any questions regarding the managers or the markets?
Looks like Dr. Oliver has a question.
Yes, I don't have a question. I just have a comment. I think all of the information shared has been very helpful, and I am just impressed with what we have to date. All things considered, everything is, I think, trending overall good. So I'm just pleased with tonight's presentation and Mariner as a whole. So I just wanted to state that.
Well, thank you for that.
Appreciate the comments. Thank you so much. Christina, did you want to give a quick bullet on your conversation with Fairview, and then Gwalda can kind of tell you where Mariner sits with that manager?
You on?
She's on mute and off
She's
camera.
on,
So
Chris, you're on mute.
Maybe she had a 6 o'clock hard stop.
Or she may have stepped away, maybe because she turned
Her
off.
camera was on the whole time, so she might have stepped away.
Do you want to? We can.
Yeah, maybe in the interest of time, Sue, if we just want to, maybe we'll put it on the agenda to talk about Fairview at the next meeting, because I think we were just looking through the presentation, and I think what they're saying is they have a 48-month close, and did they just start marketing this? So it looks like they might be there might be a little bit of runway on it. So, but again, Gwilda and I can sort of give our thoughts at the next meeting on where our research team is with the investment, how the investment, may or may not fit with respect to the pacing study. And, I think certainly with the runway that they have on it, it's probably something that maybe we can even address as part of the next pacing study. So, Gwilda, I don't know if you had additional thoughts.
No, actually our research group, it's a venture. This is venture, and then we've got to look at how that would fit into your overall private equity portfolio. So we'll have to have our research group do some more vetting on it because it is not currently an approved strategy. I guess that's all that we have for this meeting, unless there's some questions or comments.
Well, the next meeting would be August.
Yes.
Summer break.
Thank you, Gwilda and Jeff. Enjoy. Happy Juneteenth tomorrow.
Same to you.
Likewise.
Everybody
Hey,
enjoy.
Golda, before we go, did we talk about Exponents' letter? You know, I was trying to get off on mute.
Where you been, Chris?
I've been on mute. I'm trying to deal with something with the bank at work, so I'm still at work.
Oh, that's right. I'm sorry.
Did we talk about Exponents?
We talked a bit about it during the presentation that we're still watching them. We've given them till the end of the year to show continued consistent outperformance. They actually outperformed this particular month, which has brought their fiscal year to date number up. But they know they've got to continue to show outperformance, through the fourth quarter.
And so I did not go to dinner with them at NASC because I knew this was happening. So I just kind of said, sorry, I'm overbooked. And two, everyone from Tina to Caesar to Lisa to Keela, everybody apologized profusely for the mistake that happened. Just took mental note. But I told them they are on a short leash and there is nothing we can do until we can see some numbers. You can apologize all you want, but that's not the reason why you're on watch, right? The reason you're on watch is performance.
Right.
So I just wanted everybody to know, just full disclosure, that, I did not go to, go to their breakfast or go to the dinner because I did not want to have detailed conversations, except that I listened to the apologies and said, thank you for the apologies. But I refer them all to you, Gwilda.
Yep, I know.
You got an earful, I guess.
So, Lord. I just want to say, I just wanted to jump in, and then I appreciate looking into the Fairview opportunity if there is one.
Yeah, and Christina, so you were on mute, and we gave the rest of the group a quick update on that, but we do have our research group taking a look, and we're going to sort of factor in what they're offering relative to everything else we have potentially lined up for, based on the pacing study. That one, because it's a fund of funds, I think they have probably a little bit of a longer runway of how they can raise capital. So it looks like they'll be raising capital for the next 48 months. So I think it probably at least gives enough time. It's not a gun.
Oh, I thought they were closing in December. That's why I was pushing.
We'll have to confirm that with them, but that if they are closing in December, that makes it probably even trickier, just because number one, getting our vetting done on it takes time, and then again, I think we kind of know the process of getting it approved to board, legal, and all those kinds of things that makes those kind of closings pretty tricky. So, but yeah, we'll confirm with them when the actual close. Again, I was looking at their presentation and it said a 48-month capital raise. But so again, if they've been already at market with this for over a year, then maybe the December the December close makes sense. But we'll have to figure that out with them.
Thank you so much for taking a look at it. I appreciate it. I've been multitasking here, so I appreciate it.
Yeah, we already have a research group looking at it.
Thank you. Thank you. Well, I'm going to be the good one to say, if there's no further business, can I get a motion to adjourn?
Well, I guess I'll go on mute because that's what I was here for. I'll make a motion to adjourn our meeting today, and it is at 6:09 on the day before Juneteenth, June 18th.
Thank you, everyone. Second, is there a second?
Second.
All those in favor, please say aye.
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 Thank you, everyone. Have a
Thank
blessed
you. Enjoy the
weekend.
weekend.
We'll see everybody in August.
August, man.
Thank you. Thank you, everyone.
All right,
right,
have a
see you
great
later.
Juneteenth, everybody.
Okay, you
Thank
too.
you.
Thank you.
All right.